Hi, everybody. Welcome to the Sales Lab. My name is Anthony Grost, host of today's program. Today, we're going to talk about the fast-changing real estate market and the risks and reality for buyers and sellers today. My guest is Selma Hepp. She's the Deputy Chief Economist at CoreLogic and author of many articles on housing. She is responsible for analyzing, interpreting, and forecasting economic trends in real estate, mortgage, and insurance. So I'm delighted to have her on our program to share her insights. Selma, welcome to the program.
Yeah, thank you. Thank you, Anthony, for having me.
Absolutely. The housing market's changed a lot from my seat in the last year. A lot of things are now potentially impacting or disrupting the market. We've seen incredibly fast rising interest rates, continual record home price appreciation, inflation, demographic demand. As millennials are aging into home buying age, we have this huge surge in demand. And we also have some of the lowest buyer sentiment we've ever recorded in the Fannie Mae housing survey. So a lot of disruptive forces out there. So from your seat, what is the health of the U.S. housing market?
Yeah, so surprisingly enough, the housing market remains pretty resilient, particularly in light of all the factors you just mentioned, rates, low supply, inflation, concern around inflation, and consumer sentiment. We do see some slowing in recently in terms of just contracts being signed and mortgage purchase application, but it's still hard to tell really where it's going to all land. I think because the demand was so much larger than supply, even for those folks on the margin that fall out of the market as a result of all of this, we will still have enough demand to keep the housing market pretty strong.
Yeah, and we've definitely in our business have seen a slowing,
Mhm.
but slowing doesn't mean stop. It
Right.
just means, it's slowing. Now, I'm in the mortgage business, so mortgage rates have recently increased at the fastest rate since the 80s. I mean, we've seen a pretty exponential increase, 2 to 3 percentage points increase in rate.
Mhm.
But as you mentioned, we did see some slowing, but not a lot. Home prices are still rising.
Yeah.
When will housing prices and demand begin to care about mortgage rates?
Yeah, I think they already do. I think it's just that by the time it plays out in the data, it's going to take a couple of months. So I think there will be fewer homes selling over the asking price as a result of higher mortgage rates. I think there are fewer bidders out there, which was result in lower sales price over list price ratio. But so I think by over the next couple of months, as it all bakes into the numbers, I think we will start to see really how much the market is being impacted.
Yeah. And that's always the hard part you have to, so a lot of our data is historical. So,
Right.
but it's definitely, we're seeing mortgage rates actually impact a lot of our buyers. One of the things that I'm really beginning to wonder about is inflation's impact on buyers. What are your thoughts on how inflation is or may impact home buyers today?
Right. Yeah. So I think on your day-to-day activities, obviously it impacts people that have more constrained budgets, and so when you have much more to spend on gas, on food and things like that, it matters a lot. But I think for the majority of the people that are currently in the housing market or trying to buy, that increase is not substantial enough to where it's going to deter them. That in itself, I think there are other things to deter them, but not necessarily maybe inflation itself. The concern actually is that because home prices have been growing so fast and rents as well, the concern is how that plays into the inflation numbers.
Mhm.
Housing is about 30 to 40% of CPI. And so, but it takes time for these increases or changes in the market to really play out in the inflation numbers. So inflation is going to remain elevated, or seemingly the top headline number is going to remain elevated as we we actually, as these increases we've seen over the last year, fully bake into the inflation numbers. So, that's really the concern long term, is if we see an anchoring of inflation expectations. And by that I mean, if people start thinking that inflation is going to be a long term issue, and then they start making decisions based on that, and they say, okay, well, a year from now we're going to have that much more of an inflation, so let me just hurry up and buy everything right now, and that increases demand, which puts pressure on prices and then exacerbates inflation. So this is where there may be a problem going forward.
Okay. Yeah. And I mean, there's numerous potential risks out there right now. One of the things I hear people talk about that we get a lot of questions about is, are we in a housing bubble? Are we at risk of repeating price declines that we saw in, say, '06 to '08? And are we in a similar situation? And if not, what's the difference?
Yeah, I mean, it's a great question, and I get that question a lot too. And it's sort of like dodging the dodgeball, in the sense that you have to really provide a convincible story to people, because some people are very convinced that it's a bubble out there. But let me start with this. So, the increase in home prices this time around was driven by a much different set of factors than we would have had last time. So we have actually traditional home buyers that came in a market where they were faced with the opportunity to not have to stay in the same location where they were. They could work from home, they could move to other locations. And as a result, we actually saw an increase in demand from what we would have seen if we didn't have the pandemic. And so there was a study done just recently, it was published, that showed that half of the increase in home prices over the last couple of years is actually due to work from home opportunities and consequent increase in demand for new locations. And so when you look where we've seen highest, at least up until this year, because now it's hot everywhere, highest home price growth, it was in locations that were generally affordable prior to the pandemic, but offered amenities for people to enjoy them, such as beach locations. Florida was a really hot market, or they were affordable and offered, say, there was no income taxes, so a lot of demand went to Texas and Nevada. Just two examples. But the other reason why this is very different is that we have very different underwriting practices that we had last time around. In fact, a lot of the buyers over the last couple of years had excellent credit. The credit scores on average have been going up over the last few years. So it's really stellar buyers that have been able to buy. And they put 20% down. So in some way, using terminology from last time around, they have skin in the game, and they were actually living in those places. So a lot of there wasn't as much speculative buying that we saw last time around. The other thing that's different as well is, new construction was much different this time than last time. And in fact, we continue to lack, and we are in significant deficit of a home supply of homes for sale. So it's not the speculative buying that's fueling any of this. Let me see what other factors were there. Well, let's stop there, and we can expand on that.
No, that's a great explanation. I just heard some numbers the other day. Active listings are 1.4 million, and according to a recent study by Freddie, there's 54 million mortgage ready or near mortgage ready buyers 45 and under in the market who want to buy a home. I mean, just that imbalance there tells you, it's way different than when it was 15 years ago, where we had excessive inventory. And as you mentioned, lending back then was much different than it is today. And so it's a much different situation. You had a recent article, speaking of price appreciation, you had an article that I read recently that you had written that talked about some metro areas have had a decline in value, even in our current market. What is driving that phenomena?
Right. So, when we look historically, anytime we see a national increase in home prices, there is always about a handful or more. I mean, depends on what the economic situation is like, that are not seeing the same level of home price appreciation as we capture with the national number. And so, generally, it has to do with local economic conditions. Say, if you have an area that's losing a lot of jobs are relocating, people are moving out of those areas, that's where we're likely to see home price declines. Another example is, for the same reason, but sort of different shock event, other than the pandemic, was along the Gulf Coast. Those areas saw not only the pandemic hit them, but five hurricanes in the year 2020. So, and then prior to pandemic, they were losing a lot of rigging jobs because oil prices have declined so much that a lot of rigs were getting closed. So, this is a triple effect, on the local housing market conditions. So, while everybody else saw home prices increases, some of those markets actually saw home price declines.
Okay, good. That makes perfect sense. Yeah, I don't want to live near a tsunami either,
No.
or or a hurricane. In the article, you had also mentioned that we've seen these record house price appreciations, and you mentioned that it's led to overvaluation in many metros, and that caught my attention because how do you determine overvaluation of a market?
Right, right. So it's again, it's up to everybody's interpretation how they would evaluate if a market is overvalued. But in our data, we look at the what the income growth is of an area, and then we look at home price growth. And then if home
Mhm.
price growth is increasing at a faster pace than income, and say it's 10% increasing at 10% higher rate than incomes are, the idea is that eventually local residents are not able to afford that housing market anymore, and then as a result, home prices may decline. And so, in our data right now, a lot of areas are actually considered overvalued because incomes have not been increasing at the same rate as home prices. And some of the markets where we see actually highest overvaluation are actually markets in Florida, where we've seen some of the highest home prices. But keep in mind, again, this issue of work from home ability. So people from Northeast and even California, Mountain West, wherever you want to look, are maybe moving to Florida markets, and as a result, we have many more people that are buying that are not local residents. So even though the market is considered overvalued for local residents,
Mhm.
it this influx of buyers from with more income is able to continue to push home prices higher.
Yeah. Are you seeing in the data the, I call it the migration? Are you seeing the migration maintain its current volume, or is it declining, or have the majority of people moved that wanted to move?
Right. I think we saw majority happen in 2020 and the beginning of 2021. I don't think that we have as much mobility going on recently, but it's really hard to tell because it's hard to tell if those folks have moved permanently or not. So for example, at the same time that we have home price growth hitting record highs, we also had rent prices or rent increases hit record high, and as a matter of fact, it's up four times the rate of rent growth increases, four times higher than we've seen historically. And so the question is, do these people stay there permanently, or do they
Mhm.
eventually go back? And I still don't know that we have 100% um, assurance on either way that that's going to go, because the pandemic is still here to some extent. Actually, it seems like it's maybe getting worse in some areas. But the other thing is, companies are still trying to figure out how to deal with future of work policies. Are they going to be permanently working from home, or is there some requirement to be in the office, which may impact decisions of those folks to either move or stay put?
Yeah, that's a really big question. We even wrestle with that in our organization about our space, right? And do we need the space, and who's working remote, and that. So yeah, that's all big questions, and I guess we'll find out in the next coming years how that does impact, especially commercial real estate. So when we're talking about these areas being overvalued, I used a very simple analysis in a recent discussion I had where I just said, this is your median price home in the area and your median household income. And it was just a multiple to determine, these markets are actually, people are spending more of their income,
Mhm.
to buy a home than they maybe are in other areas.
Mhm.
And are those overvalued areas, in your opinion, are they more at risk to potential price pullback?
Well, yes, naturally. I mean, if you have, say if folks that are temporarily there end up moving, or if you have, for some reason, increase in unemployment. So say we have a recession and there is an increase in unemployment, and now all of a sudden some folks can't afford to that high mortgage that they signed up for. That naturally increases the probability of price decline. So yes, those areas are considered more vulnerable to price declines going forward.
Yeah. So in Fannie Mae's most recent housing survey, they just released it last week.
Mhm.
They have a disparity between sellers saying it's a good time to sell and buyers saying it's a good time to buy. In fact, the gap is the biggest it's ever been since they've started the survey. It was 72% of sellers said it's a great time to sell, and it was 19% of buyers said it was a good time to buy, which is a big difference. That's what 53 points.
Mhm.
Um, how important is buyer sentiment to the housing market?
It's very important, actually. It's very important in addition to, how buyers perceive the increase in mortgage rates. Some of the markets that we consider at risk of price declines actually, the risk has actually increased because of this consumer sentiment, because some areas are much more vulnerable to changes in consumer preference, consumer sentiment, as well as mortgage rates. So with the two factors combined, now that risk of price decline has actually increased over the last couple of months.
Yeah. Well, I appreciate all your input, Selma, today. Thank you for being on our program and sharing your insights on the housing market. I truly appreciate it. I'm excited to see what the rest of this year looks like. I mean, the market is definitely transitioning,
Yeah.
but it is still resilient, as you say. And while a market is slowing, which may not feel good if you're a seller, um, it is not a bad market. We continue to have strong demand. So thank you so much for sharing your thoughts with us. And from all of us here at the Sales Lab, thank you for being on our program, and have a great day.